What are the safe money options available to you in times like this? All right, so a lot of people with the market changing, this year quite a bit, and the market's been dropping. They've been concerned about what are some safe places you can put your money right now to not take maybe some financial hits in your portfolio. And so I'm just going to talk about a few options that are available to you. If you have an IRA or you have a 401k and so on, retirement plan, there always is like a stable value fund or a money market fund in those accounts to choose from. You're not taxed when you take money out of the investments you have inside those accounts and put them into a cash account like a stable value money market. It's just not really earning anything. Each stable value of money market might pay 0.1, maybe up to 0.5, not a lot. But outside of your retirement accounts, what are some safe places to put other money, maybe cash on hand? Right now we know savings accounts at the banks are paying maybe 0.1. Some not even paying that, 0.2% if you're maybe part of a credit union. There's CDs, certificate of deposits. I think they're a lot more popular maybe about 15 years ago when CDs used to pay a lot better interest rate. We see less money today in CDs than we were used to. But now the rates are creeping up as inflation is increasing. So have these rates have increased on these CDs. You can get a 1-year CD right now right around 1.9. If you look online, you can see these rates. I see there's a 1.5-year CD paying 2.5%. 3-year CDs, 2.9. We've seen a 5-year CD. I don't know if you want to lock up your money for 5 years on a CD, but we've seen rates as high as 3.5%. The problem with that is, any of these ones I've just talked about, if inflation is, well, we know inflation's higher this year and last year, but let's look at the 100-year average. About 3.25% is the 100-year average of inflation. If you're only getting 3.5% or 3%, you're just pretty much keeping up with inflation, and that's it. So those are okay options. They're safe, and that's great. You can't lose in those accounts, but you're not keeping up with inflation. Now, when we look at what are some other options, I don't know if a lot of other people know about these other options that are available. There is something called a fixed annuity. Now, not all annuities are bad. We're not a fan of some of them, but what we like about a fixed annuity, and I think they're getting to be more popular, and we've helped some people out with some of these this year, is you can get better rates than what banks are offering. But even also a little bit liquidity too, because if you have a CD at a bank, pretty much you can't take money out during that period of time. A nice thing about a fixed annuities, they're not guaranteed by the banks. They're insurance companies that have these. And they are guaranteeing the same level of protection as FDIC, about $250,000, but it has a different form of insurance through the annuities. But you see better rates. We're seeing rates on a 2-year fixed annuity about 3.3%. We've seen rates as 3 years at 4%, or a 4-year at 4.5%. So there's some better rates than what you can get at the bank. And most of these are liquid, like 10% liquid per year. Not fully liquid, but you can take 10% out. So something to consider. You can't get those at the local bank. You have to actually work with somebody who is actually licensed to offer you one of these, but something to consider as well. I think another thing is getting to be more popular now. And even personally, I put some money of my own money into this. I-bonds. So I-bond is a savings bond, which the savings bond's fixed rate is 0, but the rates are adjusted on these I-bonds with inflation. So right now, these I-bonds are paying, as of today, 9.62%. And so earlier this year, they were a little over 7. But as interest rates go up, inflation's going up, so are these interest rates going up on these I-bonds. So I think they're great. It's a government savings bond. You can go to Treasury Direct and do it. We can't, offer that to any of our clients. It's just something you have to do on your own. The limitations on those are $10,000 per year, per calendar year, per individual. So you can keep stacking them and do $10,000 each year if you choose to. You and your spouse can each do $10,000. So it's something to consider for part of your money that's definitely paying a lot more than what a bank is paying. But again, it's not going to be liquid for at least 12 months. So you want to make sure that you're not tying up any emergency funds in one of these accounts. And then the last thing we'll talk about briefly here, and I think we'll expand on this in a future episode, is FIAs, a fixed indexed annuity. Now, again, we're not a fan of some annuities, but these are ones we're a fan of. And the reason being is you can make some pretty good interest rates on these FIAs. Again, like the fixed annuities, these are partially liquid per year. These have periods of length of time, depending on what state you're in, 7, 10 years, some will go longer. That's the ones that we focus on with our clients. Typically, there's 10-year commitments. I know it's a long-term commitment, but when we're looking for safety, a safety valve in your retirement plan, you can't lose in these. When the market's negative, you take a zero. That's the worst you can do. But when the market's positive, you can make some good returns. And right now, with interest rates going up, inflation's going up, the rates and the caps and the index rates that you can get on these index annuities are the highest they've been, and I've seen in well over a decade. And so there's some pretty good opportunity to make some returns that, for example, one of the companies we work with, well, I'll just generalize it. A couple of the companies we work with have caps on the S&P 500 from 7 to 9%, which means if the S&P makes 10% next year, you get, say, 7. Some companies are paying 8. Some are paying 9. So that's a pretty good safe, but if the market is negative, you take a 0. So you can't lose in those, and there's no fees. That's just one of the options. There's some of the other options give you a percentage of what the index does. So we're seeing some pretty good returns on those as well. Not saying that everybody should have one of these. It has to fit your plan. You can put IRAs into a fixed index annuities. You can put Roth into a fixed index annuities. You can have money from the bank, just cash on hand into an index annuity. There are so many different options. We'll go in more detail on a future episode on index annuities, but just giving you some opportunities to look at some safe money. The key is you don't want to put money aside in safety as say 0.1, or even if you're getting 1% is pathetic. Long term, that lazy money will hurt you. You're actually losing money to inflation. And we could put this little flyer up here on the screen to show you, if you had $100,000 and you're only getting 0.2% at the bank, what that money should be in 10 years, what it should be in 20 years, because if you keep that money not in an account that's not making enough, you have inflationary losses, and your dollar just isn't worth the same dollar it was worth 10 years ago or 20 years ago. So the key is look at some safe options for you, whether it's in your personal funds or your retirement plan.